by recognize by recognize by recognize by recognize
Hi, Saint. How are you?
Sir, please, I'm good.
I realize that most of your friends have not submitted their individual assignments. Hi, Saint. How are you?
Wow. Sir, please, I'm good. Sir, after the opportunity that you gave it to us.
Okay.
Sir, please, after the opportunity that you gave it to us.
Yeah. Some of your friends have not
Wow.
uploaded. Some also uploaded a file in a zip folder. I don't know whether they were not sure of themselves. So I don't intend to download anybody's work on my laptop. I want
Yeah.
to, yeah, so some of them I've asked them to resubmit it, but not put it on the file. And I've extended the date again.
Okay. Thank you, sir.
Yeah. Just let them know the class has started and we don't have time.
Yes, sir. Yes, sir. Yes, sir.
I think you have to call them because I'm not seeing anybody, any active person online.
All right, sir.
Otherwise, at 5:15, I'll start anyway so that we can go on. So in the next 2 minutes, we'll start. Okay, guys. Let's give people, I promise 15 minutes. So the next 2 minutes, we'll kickstart it. And thanks for waiting. Unless you want me to give you some reggae sounds. Otherwise, let's give them some 2 minutes. Yeah.
Yes, sir.
Imadia, I've heard you. I'll start it in the next 30 seconds. So after that, there'll be a time for that. Yeah. But if I'm allowed to share my screen, I'd like to share with you with 9. Yeah. And then whilst I'm at it, I'll also prepare something for you all. And let me mute my voice. Okay. Please, can you all see my screen? Give me thumbs
Yes,
up.
sir.
Brilliant.
Yes,
Okay.
sir.
So today's slide is going to be based on funding and scaling. All right. This has become very relevant because of how entrepreneurs sometimes mistake this particular topic as their top priority. We'll see and dive into it, into details to find out why it's relevant at this point. Now, if you observe, all these weeks we've been studying about entrepreneurship in IT or innovation, we haven't talked about money until this 9th week, and it's for a purpose. By the end of today's lesson, I expect all of you to understand startup funding stages and the types of investors types that exist, okay? We also see how to build an investor-ready pitch materials. For instance, there are certain things that you have to get before anything even crosses your mind as to going to get people's money to run your business. That one, there's no negotiation about it. I'll also give you some real-world scaling strategies to any tech startup, okay? And then based on my experience and other international experiences, we'll look at some of the common mistakes we all make and how we can avoid them. At the end, we'll evaluate and analyze some scalability of IT startup and the models that exist, all right? So if you indulge me, I'd like us to, before I go on, I have gotten this video on YouTube on how startup funding is explained. I'd like us to watch it, and then after that, I'll come back and then we start class. Can you see my screen?
Yes, sir.
So you can see the
Yes,
YouTube
sir.
channel. You can see the YouTube channel I've opened.
No, it's a slide page.
It's a slide that you're seeing. So let me share that with you.
company. It all starts with a vision, the project, the product, the service. No one has done it before. Unbelievable. It's so painfully obvious. Can you pull it off? Maybe. You're two friends. You are excited. Design a logo, design a name. All fun and games. Design the concept. Things get serious. You decide to make this a company. You need a structure, a legal structure. How much will that cost you? In the US, incorporating a company will set you back anything between $25 and a few $1,000s. That's in part registration fees, which largely vary depending on where you are, and legal fees, which vary depending on how fancy you need your first shareholders agreement to be.
Hello, sir. The sound is not coming again.
Founder and 20,000 shares, or 20% of the company, for a well-off
You can't hear it.
buys them for 50.
You can't hear
It's
the
working
sound.
now. It's working
Oh.
now.
Okay.
$50,000. It's called an end. At such an early stage in your startup, it's called a seed investment. The money he pays now belongs to the company. If the company fails in the near future, which statistically speaking is the most likely scenario, you will probably never see a dime of it again. $50,000 for 20% of the company puts the value of your enterprise at $250,000, which puts the value of your 40% at $100,000. Not bad. Please sign here, here, and here. Congratulations, you incorporated your company and finished your seed round of investment. A year has passed. You're having a successful beta trial with customers. Time to hire a few more people. Rent not just a server, but a small office space. The $50,000 of seed capital only got you so far. Time to collect your first big round of cash. You will do this in a so-called Series A round. You're looking for an investment of $1 million. This time, you're contacting angel investors and venture capitalists, also called VCs. VCs are people who work for venture capital firms, which raise venture capital funds. They take other people's money, which they then invest into young, risky companies, such as yours. Angel investors are individuals who professionally invest their own money into young companies. Often, they successfully sold their own startup many years ago and are now looking to support early ventures. You contacted a few VCs and angels. Some of them you found online, some you got in touch with via friends and colleagues. You sent them mails. You sent them a business plan. Usually, they don't care much for the business plan. They want to see the team. Is it competent? The idea. Is it special? They know it's not easy. What have you already achieved? Is it promising? What could you achieve? Can you dream big? You set up some Skype calls. A bit of small talk, a lot of business talk. Describe the vision. Easy. You've done it countless times by now. They ask you tough questions. Have you heard of that other startup which does a similar thing? How are you different? You spark interest. You have second calls. You have third calls. You meet them in person. They might invest. Time to talk valuation. There's pre-money valuation and post-money valuation. The pre-money valuation of your startup is how you currently value it. The post-money valuation is the pre-money valuation plus the investment you're looking to collect. This is usually the one that you reference when you negotiate, because the investment divided by the post-money valuation equals to the investor's share in your startup. Investors want a low post-money valuation to get more for their money. You want a high post-money valuation to keep a larger share. You suggest a post-money valuation of $8 million. For the investor who would put in $1 million, this would mean a 12.5% stake in your company. A few weeks down the road, there are two offers on the table. One VC offers an investment of $1 million for a post-money valuation of $6 million. An angel investor you talk to offers to invest $500,000 for a $5 million post-money valuation. The offer of the venture capitalist sounds like the better deal, but the angel has great connections in the industry. It's called smart money. What do? You decide to go for both. You tell the angel that you have a standing offer of $6 million post-money valuation, but you would really love to have her on board. She agrees to invest at a $6 million post-money valuation. Great. How's the cake split this time? Let's do the math. Together, the VC and the angel will put in a total of $1.5 million into your business for a $6 million post-money valuation. This means that they will own 25% of the company. You, your co-founder, and your family friend used to own 100% together. With the new investors coming on board, you will be diluted. After the Series A investment, your cumulative share will only add up to 75% of the company. This dilution happens proportionally. Does this mean that you have fewer shares now? No, here's how it works. Just like your company issued the first 100,000 shares when you incorporated it, it will now issue more shares for the new investors to buy. The company can create shares just like a central bank can print money. The total number of shares of the company just changes. While your
I would like to stop here and give some context. Are you aware that anytime you borrow money from the bank, you've given the money the right to borrow to create 10 times the money you just borrowed or more? Now, that is what makes our business of entrepreneurship very interesting. When you offer your
Sir, please.
company, yeah,
I really don't understand what you just said. When you borrow money from the bank, you
okay,
give the money.
okay, I'll explain it to you. The banks creates money, first principle. The banks, they create money. Any CD you borrow from the bank, you have given the bank the right to recreate that money. In the sense that when they give you money, they expect you to also pay an interest. That interest, even though you haven't paid, they have created the money already. So on their books, all their debtors or the interest that they have accrued on various loans is money they can spend. Do you understand what I'm saying?
Yes, sir.
You remember last year in Ghana, they said the central bank printed money. Do you remember that brouhaha?
Yeah. Yeah.
Okay.
Yeah.
It is possible. Okay. That same concept is what we have here in our shares or seed money procurement through either a VC or an angel investor. Okay. So let me take that point again for you to appreciate. I'm repeating that. So
this time, let's do the math. Together, the VC and the angel will put in a total of $1.5 million into your business for a $6 million post-money valuation. This means that they will own 25% of the company. You, your co-founder, and your family friend used to own 100% together. With the new investors coming on board, you will be diluted. After the Series A investment, your cumulative share will only add up to 75% of the company. This dilution happens proportionally. Does this mean that you have fewer shares now? No, here's how it works. Just like your company issued the first 100,000 shares when you incorporated it, it will now issue more shares for the new investors to buy. The company can create shares just like a central bank can print money. The total number of shares of the company just changes, while your number of shares remains the same. How many shares does the company issue? If 100,000 shares are now only 75% of the company, it means that 100% of the company will now be equivalent to 133,000 shares. Therefore, the investors receive 33,000 newly issued shares for their investment. Since they pay $1.5 million for their shares, each share is now valued at $45. Your 40,000 shares are now worth over $1.8 million. Congrats! This whole process of a company issuing new shares to receive cash is called a capital raise. If things go well, the Series A won't be the last capital raise of your startup. There will be a Series B, a Series C, a Series D, and so on. For each investment round, the company valuation will hopefully increase. Also, each time your company takes in new cash from investors, you will be further diluted. Remember how I said that your number of shares remains the same though? I lied. Actually, there will usually be stock splits along the way, which convert each single share anyone holds into multiple shares. Hence, your number of shares is doubled or tripled every now and then, along with everyone else's. The purpose of this, and many other things that are determined in the term sheet, are a story for next time. You don't care much for legal work anyway. Your primary interest is in growing your business, which is now on track to reach new heights. It has been 6 years since you founded your company. You have successfully completed 4 investment rounds since then. You launched your product by now. Guess what? Customers love it. You're a huge success. The big blogs write about you and whatnot. Most importantly, last quarter, your company has not been losing money for the first time. The business made a profit. Time for the exit. Exiting the company is investors' talk for selling their shares. Everyone who invested cash into your business since the beginning has been quietly dreaming about a big profit. The earlier they invested, the bigger of a risk they took, and accordingly, the bigger of a profit they will get if the company really takes off. There are usually 2 ways of exiting a company: selling to one of the big guys or offering it on the stock market. If you sell out to a big company, the investors will usually sell all their shares at once. You and your coworkers, on the other hand, usually won't. Whoever buys you needs you people to stay motivated to run the whole thing. Therefore,
Okay, I'll stop here and explain this. This is a typical example of how X acquired Twitter. Do you remember? In the beginning, Elon Musk took the company, did what he has to do, but didn't really sack the main owners. He kept them on payroll. This is to ensure that they have a skin in the business, so they cannot go and create another one and compete with him. The same way, he also has to ensure that there's at least the agreements with the customers are kept, so that these guys will stay on. This is a very classical example for you to always remember how you are not to, if you buy a company or you sell your company, don't just walk out of it. You still have to stick around to ensure that the new owner gets what he asked for. It was after he has changed into X and all that, they started sacking people who he felt were weights on the payroll.
your shares will be transformed into shares of the company who bought you and then made available to you over time. This is called vesting your shares. If you leave early or you don't reach some milestones you agreed on, then you won't receive all your shares. The much cooler way to exit is to become big enough so that you will be able to sell your company's shares on the stock market. The process of doing this is called an initial public offering, or in short, IPO.
And then what's an IPO? What's an IPO? I still don't know what an IPO is.
Don't believe Martin Scorsese. How it works is painfully easy. In essence, an IPO is just another capital raise. Once again, your company will issue new shares, only that the investor who buys them this time is neither an angel nor a VC. It's the public. The day you go public, your company dumps a bunch of new shares on the stock market. From then on, people can buy and sell them among themselves. Furthermore, you now hold tradable paper, almost as good as cash, the price of which goes up and down every day. You can sell your stock into the stock market at market price anytime, with the exception of IPO lockup periods, which are a topic for another time. You floated the shares at a starting price of $64, and they shot up to over $70 on the first day of trading. Due to stock splits you did along the way, you are now sitting on 10 million shares of your company. Your personal wealth is over $700 million. You could cash in. But do you want that? It feels like yesterday that you two just had a vision. Now, you're 1 in a million. There's a lot you achieved and yet endless things to do. Even though investors call it an exit, for many founders, it's just the beginning.
All right.
This AI tool will create a
So you've got an overview of how this thing really works. Okay. So we're going to dive into it. Some of the things that have been spoken about, I'm going to break it down for you into a much better details. So here, I'm sharing my screen. Okay. So we've seen the video. Now, I want you to appreciate this concept in the sense that we have the funding stages, we have the pre-seed, and then we go to what? IPO. The last mile of the funding journey is the IPO, initial public offering. And to bring this home to Ghana, remember at a point, MTN was up for the grabs. Everybody can buy an MTN share. That is the IPO stage. They wanted to what? Make Ghanaians own part of the company in Ghana. So everybody could be able to play a role when it comes to what? Owning the shares of MTN. And that is classical. Okay, that's a classical example. And then we'll look at some sources of funding, dilution and valuation, and then what we call the cap tables. Now, what I want you to understand is that to craft a perfect pitch, at this stage, we've been able to create our value proposition. We've run our beta stage. We now know that, okay, this thing can go to market, but we don't have the money, okay? We want to scale up. We want to buy a new server. We want to get an office space to start a business. All this while we are using monies from our parents, our brothers, our cousins, and aunties to run the business. But now we need a big box to really push it in. These are the things you have to factor in. Our pitch deck, and the pitch deck is not just a pitch deck. It should come with what? A storytelling. How did you start this business? What motivated you to start it? I think I've shared countless times how I started my MedBets app, which came out of a necessity. All right. So I expect that we will be able to factor that in. And then apart from that, this storytelling should be backed up by data. Okay. What have you done so far? What are your numbers looking? Correct storytelling in a data set to convince investors that, listen, this thing is a viable business. You have their interest. All right. So there's a mathematical formula. Your storytelling plus your data will interest an investor. It's as simple as that. Okay. And then, of course, the investor will have his questions and answers, the do's and don'ts. They, most of the time, have been a serial entrepreneur or has a business going on, or is a very well-known person in the society. So they may have some questions that, listen, if I'm putting my money here, I want to be on the board of the company to aid in the decision-making for the day-to-day running of the company. Or if you are doing business with me, I don't want you to do X, Y, Z. As far as his money is concerned, you have to also factor that in. So this is how a perfect pitch must be constituting of a good anatomy of the pitch deck, the storytelling plus your current data status, and then what? Ready to answer any questions from the investor. Now, practical scaling of a tech startup is something that one must be very clear about. It is unlike other businesses or entrepreneurship that can have different matrices. But when it comes to IT startups, what you have to be very mindful of is what? Your product market fit. All right? Your product market fit. Now, I can tell you for free that before Zoom, which we are using now, came, there was Skype. All right? That could do virtually whatever we are using Zoom for. But then again, for Skype to scale, the timing was critical. So apart from you having a perfect market fit, you must also have a perfect scale timing. And I can say for Zoom that COVID was the catalyst for Zoom to just hit sky-high rocket size. Okay. During COVID, we were all home, and it became very relevant for people who want to work from home. And it was very good. At least for the first 45 minutes, you have a freemium where you can do whatever you want to do with your colleagues or Zoom members or people on the call. After that, you can restart it if it's not a bother, or if you're using it to make good money, you then have to look for the premium version and pay for the service of Zoom. Now, another thing that we tech startups must always factor in when we are scaling is what? Hiring the right people, okay? So hiring is very, very important. You have to get the right developers if you're into software development, a sales, and have a good operations. Because we as IT people, we want to always reduce the human interventions. So here we have to hire strategically, okay, to optimize all our operations. And for us, the scaling infrastructure now needs no introduction. It's the cloud, because on-prem has so many limitations. If you have your servers on premises, it means that you are responsible for security, you're responsible for even security, you're responsible for physical security, and also what? Software security or system security or IT security. And that comes at a very huge cost, all right? If you are on-prem, you are responsible for the uptime of the services. So in Ghana, you know how we suffer with power crisis. Our energy consumption is not very stable. And beyond the stability of even the energy consumption, I'm a data center engineer, and I can tell you for free that our power we even get in our homes is not clean. It's not clean in the sense that you need a proper electrical gadgets that can optimize the quality of the electricity that comes into your service. If you have a data center, you have to have a clean power backup system that will always kick in when the national grid goes off. DevOps, as I've already told you guys in the earlier lessons, developers and operations are now coming together. So you have to get a very good person who can combine both the systems and operations of your applications, okay? Then also APIs. You can talk about Flutterwave. Before they came into the scene, if you want to plug any payment platform into your e-commerce site, it means that you have to get a developer who will develop the APIs that will allow third parties to plug in. Now, what did Flutterwave do? Flutterwave gives you the API for free. They help you set up. They make everything seamless for you. And that is how they broke the ceiling. So scaling infrastructure is very, very important. All right. Now, building repeatable processes. Some of the processes must be optimized so that anybody who is not even knowledgeable in IT can follow those processes and plug into your system. And it's very important that we have a very stable process that everybody anywhere can plug in. And this comes with some consistency and understanding your own system, okay? Another thing we have to factor in is what? The key performance indicators. Trust me, if you can't measure, you can't manage. Whatever you set up as an entrepreneur, you should be able to measure. The ability to measure will ensure that you can also manage it well. So by managing, your KPIs will be very important for you to factor in. And that is the only way you can tell whether you're making progress or you are stagnant. Now, your monthly recurring revenue is one key thing that as an entrepreneur, you should always keep an eye on. And this is a metric that represents the predictability of revenue generation.
Hello, sir.
Monthly basis. Yes, Saint.
So please, it seems like we are having internet issues. If the meeting can be recorded and we can get it back, we'll be very glad.
Oh yeah. Okay. So let me see whether it's been recorded. In fact, I even have it on live stream. So
yeah, I can see the live stream. So
yeah. So it's there. So don't worry. We can always
all right.
have it there. So let me record it anyways. So I'll start from this slide. Your monthly recurring revenue is one metric that you have to keep an eye on. Okay. So that is how you can tell the money that you generate. And I can give you a classical example. For instance, if you have people who have subscribed to your services or products, those subscriptions are a measurable monthly recurring revenue. Because for them, you know that at any given point in time, those 100 customers will bring you money. Okay. Once that is done, you can indicate that you're making progress. All right. And it's a key performance indicator for businesses with subscription model so that you factor that in. Why do you think these days DSTV spends money to call you and tell you that, oh, your subscription is due, you have to renew? It's because they know that they've banked on the number of people who are on their subscription list so they can forecast their revenue and then make informed decisions. Like I told you earlier, your storyline plus your data will attract an investor or will interest an investor. And the only way you can do that is through having these performance indicators. So Saint, I'll take you for example, the business you are trying to run. You should be very clear in your mind that, listen, for this business to run, I need at least 10,000 Ghana cedis every month from the schools that are using my software. Once you're able to measure this, you know that, listen, with this 10,000 cedis, you can pay your workers, you can pay your server subscription, you can do your running around, take care of your transportation and everything. Any other revenue that comes above this 10,000 is a profit. All right. So it is something that one must be very mindful of. Now, another key metric is your churn rate. Now, it's known as your customer attrition rate. It is a percentage of customers who stop using a service product over a specific period of time. Okay, usually a month or a year. It's a measure of how many customers are lost, which can impact revenue and growth. Because sometimes you may start the year with about 200 users, but along the line, these numbers reduce. Okay, this is what we term as what? A churn rate. Now, I told you earlier that this is data driven, and this is one metric that you always have to keep an eye on. Okay, once you have this, it gives you some level of stability that, okay, if my customer numbers start falling below 100, it means I'm in trouble. So whatever you're going to do to keep it at that 100 rate, you try very hard to keep it there as your minimum. All right, otherwise you are heading towards what we call bankruptcy. Now, we also have what we call the Net Promoter Score. And this is a customer satisfaction metric that measures the likelihood of customers recommending a product or service to others. All right. Now, I can tell you for free that during the beginning of, I'm sorry to use the example, but excuse me, is the only thing I know you can remember. Men's Gold. Remember Men's Gold? Men's Gold's NPS was high. Charlie, you put 100 Ghana cedis there, you go to the next time, they give you 200. This is better than in the Bank of Ghana rates. So people were telling others to tell others. Now, that is what we call the Net Promoter Score. Okay. Now, your ability to really use customers as your main base of promoting your business is the best thing one can ever ask for. It's better than even paid advertisement. So I expect that in your business, let your current users be your Net Promoter Score. All right, let them tell others to increase your customer numbers. Okay, it's calculated by asking a customer one simple question. On a scale of 0 to 10, how likely are you going to recommend our product or service to a friend or a colleague? It's as simple as that. Now, if you see them giving you very high rates like 9 to 10, it means that these are loyal customers and they are bound to stick with you through thick and thin. Okay, if they are giving you 7 to 8, this metric means that they are passive. They are not there for you. They are not loyal to you. So they are just in between. So they are what we call the neutral customers. Those that will give you 0 to 6, and here I want you to pay attention, not 0 to 5 or 0 to 6, they are unhappy. Now, if you want to be very critical about this feedback, ensure that those people within the 0 to 6, you push them to passives. Okay? By asking them pertinent questions, direct questions like, what can I do to improve my service or improve the product I'm giving to you? And once you are clear in these particular answers, you are capable of pushing them from detractors to passives. And also the passive people there who are giving you 7 to 8 as a score, you can also ask them how you can improve upon their services and products so that you can push them to be what? Promoters. Trust me, if you spend time on this group of people, you don't need Joy TV or Joy News to promote your business for you. You don't even have to pay adverts on social media. This is a true way of growing what? Your business. Okay, and I beg of you, take this very serious and let your customer be your what? Your feedback or your best critic. Now, in earlier lessons, I told you that the best way to grow a business is to grow it organically. And once you grow it organically, you are bound to succeed. This way, you are rest assured that whatever you add to the product will meet a particular recommendation or a feedback from a customer. And that's how you grow the business. So I encourage you all to take this Net Promoter Score very seriously as a way of calculating the percent of detractors you have, all right? Now, another thing I want you to understand is the funding journey, okay? We've seen the video of how it started from the bootstrapping. Bootstrapping is when you are in your mother's garage or your father's garage, you're working from home, you're using your old dilapidated Pentium 4 computer to get a job done, okay? When you move to that stage, you try and get family members to invest in your business and all that. That is pre-seed. Now the seed is where you go and ask for money, actually banking or my banker. You see now I've been able to grow my account naturally by putting 1,000 here every month out of sales of my product or service I render. Please, now I need to grow the business. Kindly give me an opportunity to grow it by asking this money or that. From there, you go to your series. You can always go back and dilute your shares, get more investors to grow the business, acquire more servers, acquire a bigger working space, hire more workers. And then when all that is done through what we call the Series ABC, you now go to the IPO, like what MTN did, where they were able to put their shares out for the public to purchase. And that is the initial public offering, all right? Now, you can also learn how to source for capital through friends, family, angel investors, venture capitalists, government itself, or what we call crowdfunding. Now, recently, if I go into crowdfunding, if you haven't heard it before, you know people now go online, like using tools like FundMe. FundMe is a typical example of what? Crowdfunding. People may not have the money to give you in bulk, but $1 here, a CD there, a pound there, you put all that together and then what? You are able to get it. And recently in Ghana, if you allow me, there's this company that does crowdfunding. A friend of mine works there, Seiram. It's called, let me look it up. My alumni group use it a lot. They call it, what's the name of the thing? Chango, very good. It's called Chango. Chango is a typical example of crowdfunding tool. So I expect you, or if you don't know about it, please read about it and subscribe to it. And recommend it to your respective alumni or groups that you do supporting, like contributing for welfare and all that. Somebody dies, you need to contribute some money. Chango is the right tool, and it's a Ghanaian homegrown solution. And I recommend it to all of you to look at it. Then also we have the cap tables, the dilution, the valuation, and all that. So these are things that you have to understand as a tech startup and what you have to go through your funding journey. And I recommend it to all of you. Now, let's look at the overview of some of our startup funding stages, all right? The bootstrapping funding comes from personal savings, your revenue or loans from family and friends. And here, no equity is given up. These monies doesn't give them shares of your company. Let's get that very clear. The fact that they gave you 1,000 cedis to, let's say, buy a server or buy a space or somewhere or work in a hub doesn't mean they own part of your company. Let's get it very clear. So at the startup point, that is money from mommy, money from friends. Oh, Charlie, I beg, loan me some 5K. Let me start this thing. If you don't, I will give you something. All right. And usually these monies, you are supposed to pay back if things stand up, if things get well. All right. But you don't give them ownership of the company. All right. Now, it is suitable for early stage startup. Okay. This is where you can get within a range of 50,000 to 500,000. I beg you, in this our contest, convert that dollar sign to CD sign. All right. Because anybody who gives $50,000 in this country must be a rich person and he would like to have a share in yours. But 50K, a brother or a father or a mother can let go that money if they are well to do. All right. Now, investors are friends and family, angel investors or early stage capital. They use products and development, market research for initial marketing. All right. This is where you use their money for. seed funding ranges between 500,000 to 2 million. So let me be very clear with you here. If the person giving you the money doesn't fall within this category, please be very mindful what you call it. This is a well-researched paper I'm presenting to you. If the money the person is giving you doesn't fall within this particular range, 500,000 to 2 million, you can't call it seed funding. Okay, it falls into the range of what? Your bootstrapping. All right. And then investor venture capital terms here, angel investor, seed funds, they use product launch and stuff like that to really, let me say, get you on the go. Because anytime they come on board, you should know that they want to build the team to another level or build the company to another level. So they are trying to get you signed. And they use what they call smart money, which we saw earlier, using their connections, their network to pull in more sourcing into the thing. Now, another thing you have to bear in mind is your series, okay? Now, Series A is funding range between 2 million to 15 million, okay? And I beg of you, I want you to pay critical attention to these numbers because this is where the categorization comes in, all right? So if the figure doesn't fall between 2 million to 50 million, you can't call it Series A. It goes back to your normal startup stage, all right? Now, venture capital firms used for scaling these things are expanding the team, increasing marketing efforts. Then Series B will also be between 15 million to 50 million, all right? So here we're talking big money now. Venture capital growth here, you can look at expanding into new markets. So for instance, a company like Shagzy, if people come in, Shatta Wale should be in a position to tell where the people fall in. He started with what, 2 million. So anybody who is going to bring in money more than that should fall in Series A. I hope you understand what I'm saying. If the person is coming in with 50 million to 50 billion, it means what? The person is looking at what? Series B. All right. Series C is when the money hits 50 million to 100 million above. Here, we are expanding to other places, like going on to other continents and stuff like that. So in your presentation last week, some of you were looking at the capacity of Uber compared to Shagzy. So I want you to understand the context here now. Shagzy, in all sense and purpose, is an initial startup. All right. It hasn't seen much funding apart from the initial funding from the CEO or the founder. If it starts hitting the room of 2 million above, 50 million, 50 million thereabout, then we are looking at a more elaborate business. So in a way, we can forgive Shatta Wale and his startup because it is in an initial stage. Are you with me?
Yes, sir.
Now, your Series C is where you hit 50 million above to 100 million. Now, a company like MTN will go for an IPO when it wants to go beyond 100 million. I hope you understand why they did what they did. Now, no individual will give you anything above 100 million, but the public can. That is why they put it on an IPO. I hope this comes home to you as it has I've explained to you. All right. Now, this is the organizational skill readiness assessment. So please, this is like a checklist that I expect every startup that you are going to do to go through. One, realistic skill strategy. You have to have a proven impact. Your business model must be sustainable. It shouldn't be something that, like the house built with straws, a little shake up in the economy, then your business is going out of business. No, it has to be very sustainable. Now, you have to also identify your core elements, all right? Identify your internal owner for scale, all right? You yourself know how much shares you own for you to be able to dilute it, all right? Based on what we saw earlier, you should know your owner scale because you can't give what you don't have. If you have sold majority shares to people, you cannot come and scale up. Are you with me? You must always have a majority share. And this is one thing that I'll leave with you. And this is not only pertaining to this course, but whatever business you start up, please make sure you own plus 50 plus shares in it. Since you're the vision career, you have to own a majority share. That way, no matter the machinations of the shareholders, you still have the final say. Are you with me? And if you look at it critically through the IPO cycle, when the shares are diluted, yours will always be what? Increased. Okay. Number 6, you should have significant social need. Your impact should be felt in the public, not be self-sufficient alone. It should be significant. Now people can say, oh, this is it. Right now, even if the government is not happy with the MTN, it is serving a social need. You can't take MTN out of Ghana's IT ecosystem. It will fall on its face because they have the largest subscribers in terms of their users. Are you with me? And when you look at their recent data they churn out, the number of people using their data even outweighs those making data phone calls. So here, they have a significant social need they are serving. Number 7, the solution should be adaptable. It shouldn't be cast in stone. It should always be able to change and be very agile. All right. So your IT solution you're providing should be adaptable. It could be used. So whatever you're using should be meted for only one group of people. It should be able to be very malleable. Sorry about it. And I can use MTN as an example. Businesses are using it. Farmers are using it. Tech giants are using it. I'm using it now. Are you okay? Academicians like myself are using it because I'm teaching you through my MTN TableNet. So it should inform you that your system must be what? Adaptable. Okay. Then the processes must be what? Well streamlined. Okay. Right now on my MTN mobile app, I do a lot of self-service that I don't need to go to their help center or their offices. I do everything on my phone without necessarily going anywhere. All right. I can say same for Airtel Tigo as well. Because right now, I don't remember the last time I went to my Airtel Tigo office. On my phone, I buy data, I send credit to my parents, I send money to people on that same app. Okay. Now, the 9th thing is what? Consensus to scale. The business should be viable to grow. It shouldn't be capped in just one area. And I love what you guys did with Shagzy growing into other cities and communities in Ghana. That is a potential growth pattern that it can scale up. If it answers all the challenges it's facing now, it can easily spread to other parts of the country. Are you with me? Then you should have brand recognition. Don't be out of sight. You should have a proper brand recognition that people can associate you with the logo. They can associate you with your tag or your motto or whatever somebody says. For instance, when I say MTN, by default, everywhere you go comes to mind. They have been able to create a proper brand recognition. And that's something I want you to what? Always bear in mind as you go through your organizational skill readiness assessment. And last but not the least will be what? Available implementers. Available implementers. Don't be the only service provider. Give yourself up to other people to also get into the value chain. All right. I'll use Saint business for instance. Saint, don't say you are the one doing everything. As time grows, so if you're ready to adapt, have regional offices, have a relationship with the Ghana Education Service, so that of all the various learning management systems that are on the market, GES will acknowledge yours as one. So in your company logo, there should be, or website, there should be some partners with Ghana Education Service. There's a big endorsement for your solution. So at least people who are in the academic industry will know that, oh, this is something that has been vetted and approved by the GES. Because for instance, when it comes to food industry in Ghana, nobody is allowed to put any food on the market if the FDA have not approved of it, let alone even advertise. Are you with me? So these are the 11 key points I'd like you to keep if you want to scale up your business. Without you checking all these boxes, I beg of you, go back, do your homework, and make sure you meet all these 11 requirements. All right. Another thing I'd like to share with you is your pitfalls to avoid. Trust me, I believe everybody must be given the right to fail. All right. But when you fail, don't repeat the same failure. Okay. So I beg of you, these things are things as an entrepreneur I want you to always bear in mind. Scaling too fast can give you a knee-jerk thing. So don't be in a hurry. to blow, okay? And I'll give you a classical example. I'm in the fashion industry as well, and I can tell you, I know of fashion houses that came, they were doing a lot of loud noise, they were going on TV stations, they were going on radio stations, they were styling celebrities, and all of a sudden, they went quiet. If you scale too fast, it will be too soon for you, okay? So one, try and avoid this pitfall. If you don't have the muscle to produce to scale or provide a service, please don't scale up. If you don't have a call center, don't scale up. Okay? If you don't have the human resource, don't scale up. You know you're the same person doing the accounting, you're the same person doing the operations, you're the same person doing the development, you're the same person doing the marketing. Please be mindful when to scale. All right? Now, don't ignore the unit of economics, because the minute you go out there to advertise, the numbers will shoot up and you cannot afford to disappoint many people. All right? And also, don't misalign your team and vision. Make sure everybody on your team are singing from the same hymnal book. They understand your concept, they understand your principles, and they go by and work by it. All right? Customer support under pressure. If you scale too fast, you frustrate your customers. All right? So make sure that you avoid all these pitfalls when you are scaling up. Now, an example that I would like you to take, for example, is what? Paystack. Paystack is one of the main Y Combinator Accelerator program that came up in 2015. And here's how they grew. Their revenue growth grew from $1,300 to a substantial amount, with a monthly growth of what? 15 times in transaction revenue. User acquisition. The user base expanded rapidly with over 400 merchants on their waiting list and 12 pilot merchants. All right? Partnership. They partnered different major banks in Nigeria, including Access Bank, Zenith Bank, GT Bank, and others, to provide proper payment services. So you see how they grew in a very systematic way. All right? Apart from that, they expanded their services to cater for both technical and non-technical business owners. So even if you are not IT savvy, they bring the IT services to you. They make sure that they get you on. Okay? And we're giving services to people like Domino Pizza, Taxify, and so many. All right? Team growth. The company grew its team, okay, with the owner joined by another co-founder. All right? So here, they allow the team to grow to provide a service at its optimal stage. Now, product development, what they did was to continue developing the product. After their viable product, MVP, minimum viable product, they started adding on, providing more systems and adding more value to their product, okay? And so they became a full stack payment API, all right? And the Y Combinator program provided Paystack with necessary resources, mentorship, network to still scale their business. The company's focus on solving real-world problems and its commitment onto innovation have contributed to its success. Now today, Paystack is the leading payment solution on the continent and processing a very huge number of transactions per day. Because before Paystack, I have been a victim. I have customers who pay me online, and before they pay me, the payment switch is in the US. So if they're paying me $100, I only get $70 because the American people will take $30 out of my $100. Did I go or come? So with Paystack, all these things will be reduced. So this is how they scaled up. And it is a good example that I would like you to emulate. You can read more about them as well. Okay. Now I want you to search online for this scaling checklist, read more about it, and then get your good metric also in Excel. Okay. Now for assignment, I know you've done your midterm already. I expect you all to create this pitch deck on your respective individual thing you did for your own good. Okay. Create a pitch deck, your investor role play, and your scaling strategy. Are you okay? And you can get these resources online to help you do this. Okay. And I added some bonus material for you to also read and see how it's done. And I'll create a session for you to submit your things. All right. Before I move on to the next thing, I think it is now 6:07. We have 2 hours more to go. Do you have any question for me before I start the next lesson?
Hello, sir.
Yeah, Eliza.
Yes. So there are rumors that the guy that Richard Nee, the guy. There are rumors that he's an angel
the Bills
investor
guy.
he's an angel investor to Pizza Man.
Yes. I think on his birthday, they made that public.
Oh, okay.
Yes. So that's a classical example. Someone like that, he has the experience, he has his own business running, he has the money, but he doesn't have all the ideas. So if your idea is very viable and you check all these scaling list, 11 scaling steps I've given you, it's somebody who you can approach. Okay. And I know there are a lot of businessmen in town who have the money, but they don't know. I'm sure if you had met some of these NPP guys who had stashed money, they would have supported you one way or the other. But here we are now. Okay, some of them are being caught, and I heard they are flashing the money down the toilet. So that's another way to look at it. Yes. Any other question? All right. So I'm going to move on to the next one. We are going to look at our next lesson, which is going to be based on slide 10. Yes. Okay. So this is going to be based on what we call risk management and resilience. Guys, every business must identify its risk. Okay? Because the higher the risk, they say, the higher the reward. But beyond that, how do you build in mechanism so that when the shocks come, you can withstand the shocks? Because I can assure you, there will be shocks. There will be challenges. You will have issues with your startup, okay? This lesson is going to give us some understanding of how we can manage our risk and build a resilient business. Okay, at the end of this lesson, I'll show you the different types of risk entrepreneurs face. We'll analyze the assets risk in IT ventures, and we'll see which strategies we can apply to mitigate some of this risk effectively. And then we also have to we'll learn how to build resilience as an entrepreneur when we face setbacks or failures in our entrepreneurial journey. All right. Now, first of all, I'll show you what is risk management, common types of risk, financial risk, market risk, operational risk, legal risk, regulatory risk, reputational risk, and then real world case study for us to follow. Okay. Now, what do we mean by risk in an entrepreneurship? The risk in entrepreneurship refers to uncertainties involved in starting and running a business, okay? Entrepreneurs constantly face decisions without knowing the exact outcomes. And these uncertainties can pose threats or open new opportunities. So here, like the Chinese say it, every challenge is the same as what? An opportunity. So sometimes these uncertainties can give you a new avenue or a new opportunity, or it can be a threat to your business. So it's very important for us to look at it not with a closed mind, but with an open mind, okay? Have the chance to identify this particular risk and don't look at it as a setback. Look at it as an opportunity to relaunch yourself or do something that will change the focus of the business. Now, launching a new mobile app might seem exciting, but the risks include customer disinterest, security flaws, and funding issues. And I'll go back to connect this to why we always have to have what we call an MVP, a minimum viable product. Now, if your product is very viable, you just start with a little one. So that based on customer interest, you can add on. So that if you release your MVP and it is not successful, you cut your losses. All right. And I can tell you for free that one thing that I've learned as a project manager is that there's a principle in Prince 2 that teaches project managers that, listen, if you are doing a project and in the initial beginning, you can't justify the business model or the business case is not justifiable, stop the job or stop the project. Because if you refuse to identify the threats that are going to cause the business not to succeed or the business case not to succeed, you rather incur more cost in proceeding with that particular assurance that it will work. If you are sure that the business case is not justifiable, stop it. All right. Now, here you need to be be truthful to yourself. Let me put it that way. Be very sincere to yourself. And if you know that this thing will not work, just cut your losses. So you always have to start with a minimum viable product, your MVP. Okay. Now, these are type of risk, and I'm going to run you through them. Financial risk is when you run out of money. Okay. When you run out of money. Sometimes the whole idea of being an entrepreneur, starting a business, overshadow the realities on the ground. Okay. That Charlie, you realize that, listen, you've hit rock bottom. No money is coming in. The products are on the shelves. They are not being sold. Nobody is calling you to offer a service, and you are cash trapped. This is a classical case of what? A financial risk. And that risk is what we call market risk. Is there a real demand for the product? Here you are thinking that what? Everybody needs a medical aid or a medical service. Not everybody. You go to a village whereby they are very accustomed to their herbal way of life. If they have malaria, they know when they hit the bush, which particular tree or plant to plug, come and prepare some syrup or odido, as they call it, and then quickly the malaria will be out of their system. Okay? They get bitten by a snake. They know that herbs to combine, and then the snake poison will not affect them. You can't sell a snake syrup to such people. The point is, such a case is what we call a market risk. Is there demand for the product or the service? All right? That's a classic example of a market risk. Operational risk. Can your team deliver? Here you are claiming to be the best network service provider. All right? You do network hardware, but meanwhile, there's nobody on your team who can terminate a Cat6 cable. Apart from you, nobody on the team can terminate a Cat6 cable, let alone do a proper labeling of cabling when they are doing a network work. So you have to ask yourself, can your team deliver? If they can't, then you are facing what we call an operational risk. All right? Legal and regulatory risk. Your company lives in a country. And a country like Ghana, we are governed by law. That's what they call the rule of law. The constitution is very clear on what every company must do. You have to be compliant with the company code. All right? So you have to ensure that you are conform with what goes into the company code. When you register a company, there's a form that is attached to it that tells you the company code. As a business owner, you are expected to read thoroughly and understand the legal obligations and the regulation that is expected of you as an entrepreneur. If you go contrary to those regulations, you are not in compliance, and the law can come for you. So such risk is called legal or regulatory what? Risk. Another risk is technological risk, where you want to scale up. But here you are in this whole environment, power is not guaranteed, and you are doing on-prem. You can't stay on 99.999%. All right. So here we call it what? A technological risk. Reputational risk. Okay. For instance, last week in your presentation, I expressed I wanted to raise this issue about reputational risk. Someone in your presentation mentioned that Shatta has used his image to back Shagzy. All right. That's a reputational risk. If today Shatta comes out to say something that is very unpalatable and it's gonna make people very uncomfortable. They may attribute that to the Shagzy company and not use the app again. No matter how much money you've pumped into it, if you have reputational risk, it's gonna affect you. And a classical example now happening in Ghana is this lawsuit that Sarkodie has put up against EcoBank and the gentleman who is his whatchamacallit, is look-alike. This is a reputational risk. Yes, you want to show that there are fake people online who will scam you pretending to be EcoBank, but they're not EcoBank. Then you go and use an A-star artist like our brother Sarkodie. He has the right to complain because he's a real deal. If you want to use his image or a fake version of his image, at least seek his consultation or seek his clearance. Now this, if the court takes it up and it can have a reputational risk to the bank. Yes, they'll get attention. Any form of attention is attention, but it could be bad attention. And this could be a reputational risk for Sarkodie or even the bank, depending on how it goes. All right. Now, in Ghana, a classical example, ride-hailing platform like Bolt and Yango, they face regulatory uncertainties and public backlash. A mix of what? Legal and reputation. Shagzy, we can say the same about Shagzy. So I want you to bear this in mind as entrepreneurs. These are the various risk pitfalls you have to avoid. Right? Now, there's a matrix I've designed here to help you assess your risk status. All right? So a tool to consider your risks based on what it is, the likelihood that it will happen, the impact. All right? So server outage, you have to pay attention. In Ghana, you are guaranteed that some doomsday will happen. Your internet is not reliable. The connection is weak. But you just complain that I should record this particular session because the tendency of having a smooth internet connection is very high. And lo and behold, it's a likelihood. It will impact the business. Okay. The action plan is use the cloud. So right now, as I'm teaching, I'm streaming on YouTube so that you have a backup online. That is how I am mitigating my risk. All right. Use the cloud as a backup. Now, client non-payment. Here, sign contract upfront. All right. That's how you mitigate it. People will tell you, I'll use it for free for some time. But please, let them put in their credit cards. Let them put in their payment models. So that if the subscription kicks in, you are not now going to ask them for their credit card details or payment details. Automatically, there's an upfront payment or something to deduct to take care of the exigencies. Now, in real time, this is something that the hotels do. Whenever I'm traveling and I need to book a hotel, I have to provide a credit card detail to the hotel I'm trying to stay in when I travel. There's an initial money they will block. They may not take it, but it goes into some form of an escrow account so that they will know that they have blocked the room for me because I've made commitment. Now, as a tech startup, this is how you can also mitigate this risk. Always get some paying upfront. All right, let them pay something. Maybe it's the things 100 cedis. Let them commit by some maybe 10% upfront. That's the way there's some resilience you are building. So if the people don't come, at least you've gained something out of it. Regulatory change, you must always monitor policies updates. Some of you, you're not interested in what happens in parliament, but it does. It does matter. In Ghana, for instance, the past week, we have been able to scrap the e-levy. E-levy didn't start from your bedroom. It started in parliament. So if you are a company that charges e-levy, you should be up and running and knowing that, listen, I have to alter my invoice bill, my invoicing formula and take out the e-levy. Because if you charge, you have to refund it back to the people. The government is no longer taking it. And if you're taking that money, it is theft. So as a startup, you have to be very sensitive to regulatory changes. Always monitor the policy updates. Right? Now, I think we've exhausted this point of SWOT analysis, where you have to look at your strength, your weakness, the opportunities, and the threats. Now, in this case of risk management, you have to identify your respective risk position. By what? Look at your strengths. What can you reduce in terms of risk? For the weakness, where are your vulnerabilities? All right, you have to look at, well, I don't have developers, or I don't have proper power solution, or let's say I don't have a proper backup. I have to think of the cloud. That's a weakness. All right, opportunities. We can speak, or you can spot risk and early adapt. You know that, listen, this business, for it to work, I need to be online 24/7. So don't waste your time buying servers and keeping it in your house. Please look to the cloud as an opportunity to stay online 99.999%. Okay, high uptime. All right. Your threats. What external risk do you face? As I speak to you now, there's a tariff war in the world. If you are keeping your things on a solution provider in America and they just come and slap a tariff on you, those are threats you have to look at and diversify your portfolio so that at least you don't keep everything in one basket. All right. So this is how you can also use SWOT analysis to reduce your risk focus. All right. To mitigate this, you have to diversify. Don't rely on one income stream. Like I always tell you, I'm a Christian, so I can use that as an example. Even the Bible says that in the Garden of Eden, there were 5 streams that was feeding the garden to keep it nourished. So what business do you have just depending on one income? You have to have diversification. Don't just look at one level of subscribers. Diversify your portfolio, okay? And so look at it. Saint, don't just focus on secondary schools. Look at junior high schools, look at primary schools, look at universities to use your solution for the learning management system you're developing, all right? Insurance is a very good risk mitigator, okay? Always ensure that you insure not only yourself, your servers, your inventory, and even things that your team members, all right? So at least when there's any lap, you can always fall on the insurance companies to back you up. Have a contingency plan. You have to think of the what ifs. What if the unfortunate happens? Look at how COVID put a lot of businesses out of business. Look at the aviation industry. It went down on its knees because of COVID. Nobody was flying. Nobody was doing anywhere. Nobody was going anywhere. We're all home. So you must have contingency plans. All right. And one of the things I want to always factor in to be agile. Okay. Always iterate quickly, reduce losses, learn fast, make your changes. Okay. Try and reduce your loss and don't make big bets. I mean, go in a very slow but very steady pace. Okay. And make mistakes quickly and learn from them. All right. An example is the Nigerian startups. They are very agile. They release things on a guard and they roll it out as and when new services arise. Right. I can talk about Paystack and all those things that they are doing very well. Okay. Now, how do you build resilience? All right. This whole thing about risk mitigation and management is about building resilience. All right. And here, Japanese proverb puts it in the best context. Guys, if you fall 7 times, try and stand up 8 times. Don't stay on the ground. Keep coming back. Now, resilience is our ability to adapt, recover, and keep moving in the face of failure and pressure or adversity. All right. So please, this is not something you can only talk about. You have to build it. Okay. You have to build it. And it is something that is action oriented. It is not just a word of mouth. And this is how you build resilience. Why does it matter? I can tell you for free, entrepreneurship is tough. Okay. Failure is almost guaranteed at some point. What matters is how you respond. All right. And you don't have to react. You have to respond. And here, I'd like to share this with you, that there will be times whereby money to even visit a client is a problem. But don't let it be a breaking point. Okay. Let it be rather a stepping stone. Go out there and defy all the odds. Okay. And be very resilient. Okay. Case in point is Flutterwave experience. They had a major setback, including regulatory fines, cyber threats, but they were releasing leadership and helped them bounce back. So it will not be a walk in the park. I must tell you this for free. It's going to be very challenging. But like the Japanese proverb says, if you fall down 7 times, please get up 8 times. All right. Entrepreneurship is tough. It's almost guaranteed to, at a point, Flutter Wave experience same thing. So I expect you to do better. For your assessment, and this I'm going back to the respective assignment you did. The group level, you have to do it for Shagzy. Your individual assignment, do it for individual one. I want to identify 5 risks, okay? Rate their impact and likelihood to happen. Add a mitigation strategy, and then present it on a 1-page contingency plan, okay? Assignment 2 is peer review, okay? Choose anybody among your mates and then give them your plan for them to discuss, and let's see how we can. So next week when I come, we'll discuss this in class. I don't know why CFAS is going and coming like that. Either it's in Peru or something. So guys, this brings us to the end of today's lesson on how to build resilience and manage our risk when it comes to what? Our IT entrepreneurship. Thank you very much. And I'm open for any questions that you have for me.
Hello, sir. Good evening.
Good evening, guys.
Sir, I would like to know,
Yeah.
is it advisable to keep pivoting when you see failure? Is it good to keep pivoting? Like maybe each time you see that you're about to fail, you pivot, like maybe 3, 4, 5 times.
Yes. It becomes necessary if you don't see any way out. Because pivoting is better than you just folding your bags and baggages and walking away and putting your CV out there looking for a job. You have to be agile. Like I said earlier, you have to be very agile. Change your methodologies. Maybe the program will work, but maybe it wasn't designed for Ghana. Are you with me? Maybe it would have worked better if you're in another country. I'll give you an example. When I designed my medical bed app, I took it to Japan. It was good for the purpose I took it. People loved it. But I realized that the medical infrastructure in Japan is far advanced than Africa. And Ghana, to be precise. Their medical system works. They have proper systems that are able to respond to emergencies. So that was the wrong market. So I couldn't have pivoted to Japan to sell that product or that service. Are you with me? So you have to be agile and look at what works for you. But you can pivot, because sometimes if it is a solution you've developed, the core business model will work, but you just have to change the target market or your channels. All right. So if you don't see any way out, you can pivot. Yes. Any other question? I'm listening. Any other question? All right, 6:31. I think we've done very well. If there are no other questions, I'd like to bring this class to an end. And a little public announcement. I have extended your individual assignment submission. Some of you were doing it via zip file. I'm not very happy with it. Upload the file directly on the thing I gave you. All right. Upload your assignment directly, both the video, the pitch deck, and then your material. Okay. I don't want you to put in a zip file. Secondly, I don't want to download it onto my machine. Okay. I want to look at it directly on the Google Drive. I don't want to download it. Okay. Any other thing? Any question on that?
Hello, sir.
Yeah, Mark.
Yeah, please, when you are sending the you're uploading the file, gives you only one chance. So after uploading the Word document, it's very difficult to also send the video. That is why some people zip the file so that it comes as one folder or file. I don't know if you
Okay.
get
So
it.
when you're uploading, select all the files. Because some people did it that way and it worked.
Okay, sir.
All right.
So we should unsubmit the one that we've already submitted.
Yes, you can do that. You can redo it again. And please
Okay.
don't send it to my email. It's I can't evaluate you on my email. Because you see, when I finish the evaluation, I'll download the whole Excel sheet and then I'll update your midterm assessment with it. Because you know, it forms a part of your midterm assessment. All right. Okay. So can we call it a day? If there are no more questions. Okay. I want to thank you all, and I look forward to seeing you in class, God willing, on Friday, next week Friday. Next week Friday, I think we are going to look at what are we next week Friday? We're going to look at ethical entrepreneurship and social responsibilities, right? So please come with your A game whilst we get that done, all right? And I wish you all the best, and happy Easter to you all.
Thank you, sir, and same to you.
Right. Stay well. All right.